It's always interesting getting the views of professional money managers, particularly heading into an important period like the company reporting season. I spoke to June Bay Liu from TenCap to get a sense of how she is thinking heading into the reporting season. What are the issues in the big picture that are influencing her risk-taking appetite, and what are the things that she's avoiding? Take a listen. It's a great interview. June, what I really want to talk to you about are your thoughts around the upcoming reporting season, but let's just flesh out like the backdrop, because from a distance there seems to be a lot of uncertainty, be it the pathway for lower interest rates in some respects. The RBA has been a little bit mixed in its guidance of late. There's the trade war, there's the challenges around a currency that's quite fluid in terms of the US dollar. Normally we talk about sticking to the fundamentals, right? But it seems as though the fundamentals are being challenged a little bit in this environment. Is that accurate?
I think accurate to some extent. When people always talk about investing in share market, it's the climbing wall of worry. Now, so it clearly seems like a lot of worries at the moment. There's all these things happening, but the market has proven to be very resilient. But one thing though, as a share market investor, what you're really doing is that you buy future earnings, right? So we are sitting here thinking in 12 months, things will be better. Hence why we're seeing such strength in the share market. And then, like you said, taking it back and look at the fundamental, what's been happening. What's been happening here in Australia, actually it's not too bad. So our economy is actually holding up okay. Unemployment's doing okay. Our retailers a little bit patchy, but there's a bit more discounting, but that hasn't collapsed in terms of demand. We already had 2 rate cuts came through that provide a bit of activity and green shoot for the Australian, the residential market, which is in turn good for confidence. And then in terms of our corporates, they're doing okay. The margin was under a bit of pressure, but we definitely saw, the inflation's come off and labor is still a little bit high, but things are getting a little bit better from here on. So net economy is holding up okay. And now we're also counting on a few more rate cuts to come through. It's unfortunate we didn't get one a few weeks ago, but it sounds like, it's just a matter of when, it's not a matter of if, right? So it's definitely coming. So, so with that kind of backdrop, it's actually really, really positive for the share market because fundamental is good. And then for Reserve Bank to cut when interest rate gets cut and when it's not a recession, it's always very bullish for equities. Now, globally, take a step back, a lot of those worries happening in the global, right? Tariff, we are seeing positive headlines, things are getting done or getting extended. So, in a way that we see it less as a shock or potential shock to share market, like what we saw in Liberation Day, because during Liberation Day, we didn't even think you could do that. Yes. So now that we sort of just seeing positive news headline and that will continuing on over the next 6 months. So net, so that's reasonably positive. And then for our companies that's directly impacted by tariff, is actually a smaller component of our ASX market. So that uncertainty is sort of seeming to be pushed out a little bit more. And then obviously you have the war and other things going on. The market seems to have a good grasp of what's happening, unless like the oil sector gets impacted directly. So putting all these things aside, share market actually looks okay for the next 12 months. If anything, actually looks pretty positive. So, we actually think that this reporting season, if you see any, sort of sell off because of earnings weakness that's backward looking, is a great buying opportunity.
So in terms of the reporting season, if you had like 3 boxes that you wanted ticked in the bigger picture from your perspective, what would they be?
Look, I think in this reporting season, what we really like to see is, just see the corporates talking through how they see the next 12 months. Our views actually will be reasonably positive. Some of those uncertainties we talked to before is in the rear window mirror. Now we have more rates cut to come through. We have positivity in terms of demand. We have inflation sort of going lower. So, all of that. But we like to see company to come through, give a bit more confidence to the market. And you see that valuation re-rate, because for a lot of those businesses, they're not trading on big, sort of valuation like people talk to. They're not the tech companies, but, their earnings linked to the economic activity. So that's what we like to see. We also like to see, from the cheaper part of the market, which is the miners. We like to see them to be more, more capital discipline. So we do expect the miners have a okay reporting season because of the prices for iron ore and a lot of commodities held up okay. So we think that they will, deliver a result that is a bit better than expectation at the current spot rate. And we do think that, given they already gave a lot of guidance in terms of capex and others, the dividend payout will be quite reasonable. So, so that we like to see that tick off. And then the last one is that we of course want to see our growth stocks to continue to deliver, because that's a core important part of the market. I do know that they're expensive, but there are just very, very few growth opportunity here in the Australian market. We like to see them continue to grow. So we like that kind of structural, growers to continue to deliver.
As a part of your investment mandate, you invest in the smaller cap part of the market, and some of the names that you invest in include an organisation called GemLife, which has recently come onto the market. So walk me through why this became attractive to you.
Look, absolutely. Well, first of all, this company is very much founder-led. Has stayed within the family for decades, and that they have done incredibly well. This business plays in the whole the retirement living space. Recently we had some negative headline with the LIC that's been under pressure because the selling model that they have was very, was not really the right model for the market anymore. Whereas GemLife is completely different. What they do is that they buy all those land and then they build. So it essentially streamlined. They buy the land, they build, and then they rent it out, and then they charge a lease fee in the whole retirement living space. And they have been operating in the family for many, many years, and they have this consistently delivered fantastic return. And now with the listing, they're going to deliver out of the land they can deliver up to 10,000 homes, which is incredible. They play in that really structurally, undersupply space in the market. We don't have direct housing exposure, whereas this one can really give you that good exposure run by good management team, and that's founder led as well. And coming off as a smaller cap, the growth is is more phenomenal compared to the larger players where you have bigger exposure, but then your growth is much less, for example, like the likes of the Stocklands and others.
One of the most challenging parts of the market to invest in are airlines. They are subjected to a lot of different variables in terms of what drives their earnings and the opposite. So you've participated in Virgin coming back to the listed universe. What attracted you about this latest iteration of the airline?
Oh, absolutely. Look, there's two things. That one is that they are the key thing is that the company still have so much room to improve in terms of operational efficiency. Qantas is a very, very well-run business, and you can see, with the investment they have had in the business, how much operating profit or how much operating efficiencies and return they can able to deliver to the shareholders. And Virgin is still just getting started, actually halfway through their operational efficiency program, and that is going to deliver quite a meaningful earnings growth, double-digit earnings growth. Now, put that aside, Virgin is actually a pure play in Australian airline space. The reason why we like it is because international. If you look at the industry in terms of airline globally, has always been a very challenging period, because challenging space, because there are so many airlines operating in that space, and the price competition has always been very, very difficult. If you just look at examples of the offshore airlines, they all go through big boom and bust sort of cycles. Yeah. And then clearly at the moment you have issues in the US and everything all gets impacted. Whereas domestic, it's quite different. In Australia, we only have so few airlines. So really, the competitive landscape has been reasonably benign. And over the many years, we have seen, the Qantas able to grow year in, year out, because of the competitive landscape. And now with the two Virgin listing also focused on profitability, we do think it's a very good environment for the airline, at least for the near term that we can see. So, and we think that that company is going to deliver very good return in a very good environment. And with the interest rate cut, with the tailwind of more leisure travel or even corporate travel, this company is well leveraged, and it's trading it was listed at 27% discount, 30% discount to Qantas. We think that gap will close.
One of the aspects of a falling interest rate environment cycle that's important to recognize when it comes to investing in shares is that that's that moment where small caps or the medium-sized part of the market actually can perform quite well, and we're seeing the small caps actually keep up with the ASX 200. So what are your thoughts around that universe, particularly over the course of the next 6 to 9 months when we are increasingly talking about rate cuts?
Absolutely. I think they will do better. You're absolutely right. Usually small to mid cap, that particular small end of the market, they're much more economically sensitive. So when interest rate is high, and also they usually have a high debt, gearing and the like. So usually when interest rate high, they're under a bit more pressure in terms of, the debt and also economic activities not doing too well. So that sort of impacts them. And now we're already seeing first early sign of it. And then we're seeing quite a bit of a valuation differential. Depends on part, your growth part of the small cap is very different. But more cyclical part, it's actually, you're finding cheaper stocks compared to the large cap. The large cap company has done incredibly well, being incredibly resilient. And now you're just seeing that there's a bit more money, a bit more confidence and money to flow through the other parts, of smaller parts of the market, because there's more return and for cheaper. So, why wouldn't you, move to those sort of space? And then, globally in terms of the economic or the sort of horizon for the equity market, there's more limited downside risk that you could see. So this is usually time small to mid cap do really well.
One of the features of your investment approach is that you can take short positions in stocks. Are there any areas that stand out particularly to you where you go, you know what, I'm just not having a bar of that, or a particular name that you're perhaps just not all that keen on at the moment?
Yeah, look, there's always a space that we're not so keen on, but I must say, in terms of the short book and in terms of where we think the share price will struggle, it actually has changed quite significantly over the last 6 months. So post the Liberation Day, you just seen the valuation, fall. You really want to move a lot of those, a lot of underperforming stock really represent a buying opportunity. Yep. If anything, we think a big part of the market actually now look quite cheap, to be honest. And then you moving into now the reporting season, it's really stock by stock. So the area where we feel still a bit of softness is that, fundamentally you look at the US housing, it's looking very, very tough. It just seems like they couldn't catch their break. And there is a bit of uncertainty with the US consumer, but it's really the US housing home builders is really under a lot more pressure. We all know the names in those home builders, and, James Hardie is clearly under more pressure because of this acquisition that's, that they have made at the top of the market, right? So with the update that's coming through very soon, we think there's definitely, there's a bit more softness across that space. But look, in terms of the equity market, we do think the opportunity really lies in the cheaper end, the cyclical end of the market, than the expensive part of the market.
Jenny, it's always a pleasure to talk to you. Thanks for your time today.
Thank you for having me. Thank you.
And thanks for joining us for the Executive Series.